This video is going to cover 3 actionable items that you can start doing today and start changing and improving your trading. So let's go ahead and get into it. The 3 items. First, we'll talk about identifying the type of market. To me, this is the most important thing, and it's what comes first. If you know what kind of market you're in, then that can guide the kind of trades you're going to take. Also, item 2, use stop orders. A stop order means that the market has to go has to go in that direction for you to get filled. So if you want to get filled with the stop order, the market already has to be going in that direction. If you're buying with a stop order, the market has to go up to be able to hit your stop order. And the third item is risk less than your reward. So essentially, it's swing trading. Now, I scalp as well, and I see a lot of merit in scalping, and a lot of my stuff is scalping. But when someone's trying to improving it better, I think forgetting the scalping until you get better and then just focusing on having a reward that's greater than your risk, there's going to be a lot of benefits to that. So these are the 3 action items. All right, first, identify the type of market. So knowing what the market's doing allows you to take targeted trades instead of just firing in the dark. All right, so the 2 types of markets, you're either in a trend or you're in a trading range. If you're in a trend, only look to trade in the direction of the trend. I know it's tempting to try to do like a mean reversal trade, try to bet against the trend. You say, oh, it's gone too far and this is my chance. In general, that's difficult to do, and I think it makes more sense to trade with the trend. Compare that to a trading range. In a trading range, you really want to focus on buying low and selling high, and bet that breakouts will fail. So it's a bit like doing the opposite. In a trend, you're actually always buying near the highs. If you think about it, like if it's a bull trend, then the market's always kind of near its highs, and that's where you're buying. So in a trend, it's okay to buy at the highs. Versus a trading range, you want to do the opposite and buy low and sell high. And then when you see the breakouts, they're actually more likely to fail than to succeed. So what kind of market is this? Well, let's look at the steps that I would go through when I'm trying to determine that. One, I'm seeing that breakouts are failing. So looking at the left of the chart, here's a high. Market tries to go above it and then pulls back in. Tries to go above again and pulls back in. So from this high now, then once again, breakout, there's a breakout attempt and that fails. The market pulls back into this range. On the downside, here's a low. Market tries to poke through it here. New low forms, tries to poke through it again, and then fails. We also see a lot of overlap. All right, so we have a bull bar, but then a big bear bar. We see tails on tops of bars and below bars, and a lot of sideways movement. We can see if you just drew a horizontal line through here, there'd be many bars touching any of those horizontal lines. You're also getting bad follow through. So here we get several bull bars, and this last one breaking above this prior high. But instead of getting another bull bar and another, it immediately reverses. Or here you get 3 bear bars, and instead of getting more down, it reverses back and comes all the way back up to these highs. So time and time again, you get this bad follow through. Breakouts failing, overlap, and bad follow through. You get a bull bar, hoping to see another one, but no, you get an even bigger bear bar. And instead of, after these 3 bear bars getting more down, you get sideways and then a big bull bar. So these are signs that you're in a trading range. When you identify that you're in a trading range, avoid buying at the highs. If it was a trend, the market would just keep on doing this and going up higher. And you could buy at the highs and make money, but in this case, it's going sideways. So if you buy high, that's a losing strategy, and if you sell low, that's a losing strategy. You need to do the opposite. Down here, market looks like it's breaking out. We've had 4 bear bars, but in fact, it's a trading range. It's a breakout's more likely to fail, and it fails and it comes back up to the high of the trading range. So avoid selling at lows. How about this market? What kind of market is this? Well, as I'm looking at it, I see that we have higher highs. So we get a big bull bar here, creates that high, then we get another high. Market pulls back, then we have a higher high here, then another higher high. We're getting higher lows. So there's a low way down here, and then The market pulled back here a couple times with these tails, then it pulled back here, pulled back again, and each time it's pulling back, that those pullbacks are ending up higher than the previous low. And I really want to point out these several strong bull bars here. I mean, these are the largest bars on the chart. I mean, 3 consecutive bars are the largest bars on the chart. That's a sign that something is going on. Someone is buying aggressively. They're buying, betting that we're going to have higher prices. The market might continue to just head straight up like this, or we might have a more controlled trend up. So I'm seeing higher highs, higher lows, and also breakout bars like this, where they're very large and they're getting follow through. That to me looks like we're in a trend. So I would label this as a trend, and you can identify that pretty early. I mean, really, as far as once you get several breakout bars like this, then you're probably at least breaking out of something, and this might be the start of an elongated trend. So yes, this might fizzle out, but there's an increased chance now after this that you will get higher prices. And trends tend to continue. Really, whatever the market's doing, it tends to continue what it's doing. So if the market's trending, it tends to continue to stay in that trend, especially as long as these lows are staying above prior major lows. So what would be the easiest way to lose money when you're looking at this chart? It'd probably be selling. Right? If you're selling anywhere through here, you're losing money, or anywhere through here, or selling during this breakout, you're losing money. So most of the losses are happening on the short side. And yes, I can see that some sellers would have made money during here or during here, but most of the time on this chart, maybe 70% of the time or more, buying was the easier way to make money. And what we're doing, we want it to be easy. I mean, choose the easy route in this. The easy route is it's going up, it's trending up, and it's better to buy. That's easier to make money doing that. So step 2, once you've identified what market you're in, try to use stop orders. Focus on using stop orders. And so why stop orders? Well, the market has to already be going in your direction for you to get filled. So if the market's going up, and you want to buy, then you would place a stop order above where the market is currently. So let's look at an example. Here we have a bull trend, and the first 2 bars here, we got a bull bar and then a bull follow through bar. Market is probably going higher. Some people will place a stop order to buy above the bar. So they'll buy right here. For them to get filled, the market has to actually be going in that direction, has to continue going in that direction. If we use a limit order, the market would actually be going down at the time that we get filled. So there's an inherent bias. There's an inherent edge when you're buying and the market's already going in your direction versus trying to buy when the market is going down. How about this? Well, some people might buy above this bull bar, right? I mean, it looks like a good bull signal bar. In this case, if you use a stop order, it did not go above the bar. If you used a limit order, if you bought somewhere down here, the market was going against your buy order, and this is what occurred. So not only does a stop order put you in better trades, but it keeps you out of bad trades, because you were wanting to buy here, but the market didn't go enough in your direction. So you were never filled. So you were kept out of a bad trade. And that's one advantage of a stop order that is rarely talked about. It's not only putting yourself in good trades, but it's also keeping you out of the bad trades. Market did not go above the signal bar. And this actually happens quite often. And so definitely an advantage of using a stop order is avoiding a bad trade. The third step, risk less than your reward. Like I was saying in the introduction, I mean, I do a lot of scalping, and I teach scalping as well. But swing trading is for everyone. Scalping is more for advanced traders, but swing trading, that's for everyone. Beginners can swing trade, advanced traders swing trade. And I think especially starting out, it's going to be a faster route to profitability if you are swing trading, if you are risking less than your reward. So the market, it rewards cutting losses early and letting winners run. This is what I found from my own trades, from my own data, from talking to other traders. This is what makes good traders, honestly. I mean, what is the opposite? What's the worst thing you can do? The worst thing is if you cut your winners short very quickly and you plan to never take a loss. Right? So if you buy and you always get out 30 seconds earlier when the market goes up a little bit. And if it goes down, you just never get out. You just let the market go against you and against you. Your win rate will be very high. But on that rare occasion when the market does keep going down, then you're going to lose everything. So doing the opposite is better than that. And this is doing the opposite. The market rewards cutting losses and letting winners run. And the goal is you don't want to take losses that are so great that they could end your trading career. So make sure your losses are not so impactful that that's your last trade. You always have to be able to live to trade another day. And by keeping your losses small, that will be much better chances that you'll be able to trade the following day. Swing trading, it requires less management and less precision than scalping. So like I was talking about, scalping is more for advanced traders for these two reasons. One, when you're starting out, you're just not going to be as precise as you need to be. Your win rate just isn't going to be high enough to be able to get scalps consistently. And also, there's less management on a swing trade. Right? You buy, and I mean, basically, you either get stopped out pretty quickly or the market runs, continues in your direction. Now, there are still improvements you can make by managing your swing trade. That's true. But scalping requires more management. So if you're risking more than your reward, then you're scalping. And there is more management that is needed for that. So you have to be precise and you have to manage the trade accurately throughout. Because if your reward isn't that great, I mean, you have to be perfect when you're doing that. You have to be near perfect to be able to make money trying to scalp. But with swing trading, less precise and requires less management. So here's a trend, so we want to avoid selling. So after these three bull bars, pretty much we have no, I mean, there's a couple reasons to sell, but the big picture is avoid selling and only look to buy. So if I was starting out, that'd be my rule. Big breakout like this, where you get these higher lows and higher highs, I'm only looking to buy. Forget selling. The market will go down at some point, and it'll give you signs you can sell. Until then, only look to buy. Here, we have a good signal bar, and it's a good signal bar in a bull trend. You could also look at it as a double bottom. So we're in a bull trend, double bottom with this little tail and this little tail. 2 attempts to go lower, and then we're getting a good bull signal bar. So the step 2, we see a bull trend. We use a stop order. That's our step 2. We want to buy above a signal bar with a stop order. To get filled here, the market has to continue going up. So there's a slight edge in our favor by doing that. Step 3 is use a risk that is less than your reward. So we risk to below this double bottom. And we use reward that's twice our risk, for example. So here's this swing trade. You buy here, stop below, and you get out 2 times or maybe 3 times your risk. And so there we go. We've completed the 3 steps. By following those 3 steps, we're going to be better off than trying to do, whatever else is out there. Another idea. Here we have a wedge bottom. Market's still in a bull trend. And then a wedge bottom, 3 pushes down, first push, pull back, second push, pull back, third push. 3 pushes down, 3 attempts to go lower that are failing, then a good bull signal bar. Nice, clear bull signal bar closing on its high. Good chance that this is going to be the low of this pullback. So wedge bottom, good bull signal bar. Okay, we're in a trend. We're going to use a stop order. So that's step 2, is using the stop order. And step 3 is risking less than our reward. So we put our stop in this spot, go for 2 times our risk up here, so we have a reward greater than our risk, and then we let the trade play out. So here's 2 easy trade examples by following these 3 steps. These are 3 steps that you can use to improve your trading today. What would we do? Identified a trend, use a stop order, and we had a reward greater than the risk. So following these steps, that's no guarantee of profitability, but from my experience, this will greatly reduce. From my experience, when I made these changes, it reduced the losses that I had and the magnitude of losses. So that's how I would state what following these 3 steps did for me. So the 3 steps, I see those as a way to get your trading under control and stop having these huge losses. I think those 3 steps will put you on the right path. What I've developed recently, this recently came out, is the big trading course. Trading is a skill, and to really master that skill, you have to be trading yourself. You can't have someone else trading for you. So this course is 23 hours of lessons, and it's designed to teach traders how to fish. It's how to trade for themselves. It's built for all levels. So I thought about, if I was a beginner, what would I need to know? Or if I was intermediate or advanced, what would I need to know to get me to the next level? The price for this is going to be $600, and I wanted to give a good deal for people that have been following, and I wanted to do an early bird price. So the price starting out will be a 25% discount at $449. I don't know if you've been shopping around much for trading education or trading courses, but this is a pretty good price for what's included. I'm very proud of what I put into this course and the effort and the content. If I was starting out learning, if I was a beginner or intermediate, this would be a great course for me. I built it with those people in mind. I built it with myself in mind. What would I need to know to get to the next level? So this deal will last for a few weeks, and then over time the price will increase up towards the standard price. Check out the link in the description to get that course, and also use the promo code that you see in the description. Hope this video helped you guys out. If you have any questions or comments, always you can reach out on the YouTube or on Discord, and I'll be happy to answer your question or have a conversation with you. Thank you guys for watching. See you in the next video.